Hello Proponomics people, and welcome to the summarised version of the Sunday supplement from the 4th of February 2024. It's the 5th of February this morning, and what I do every week is I ask Google's Bard AI tool to do a summary of the supplement because it can be particularly long, and then I talk through it on one of these videos. So first of all, just a little bit about the channel in case you don't know. My name's Adam Lawrence and I have 2 master's degrees in economics and also operate a property portfolio group of a significant size, most if not all of which has been done with joint ventures, and therefore that's my qualification for talking about how economics and property mix together, which I do on a weekly and these days daily basis via this channel. So what was this week's video all about, this supplement this week? Well, it concentrated significantly on the Bank of England Monetary Policy Committee meeting for last week. Of course, that's become more and more important as the rates have risen over the course of the last 18 months or so. And what does it mean for the economy, more importantly? People will know that, for example, they held the interest rate and might not have looked any deeper. And hopefully this will give a little bit of insight as to why I do look deeper and the sort of things that I look at. So we had some data last week about mortgage approvals. The big number was 50,000. In December, that was the number that we wanted to get over. We did get over that 50,000, but we didn't get to the consensus forecast number. So that means there were fewer mortgages issued than expected. I'm perhaps not particularly surprised by that because the rates were still really quite high back in December. And the drops only sort of happen around Christmas time, where you wouldn't have been expecting many, if any, mortgage approvals really, as the industry obviously shuts down towards Christmas apart from anything else. One of the reasons behind some of the slowdown recently has been theorised to be buy now, pay later, being more and more of an option and heavily taken up, especially around Black Friday. So people tried to save money. They front-loaded Christmas purchases around Black Friday. They used buy now, pay later, and it meant they had less money in December, January, and it will have implications for February. Let's see how that plays out when we get those figures. But I think next month's figures for mortgages will be ahead of consensus apart from anything else, because there was such a dramatic drop and we saw that psychological threshold of 4% breached for an owner-occupier mortgage. We had rates down to 3.74. We're now down at about 3.94, but we're still below that 4%. I then went on to discuss the money supply, which isn't talked about very much at all. Monetarist economists from the monetarist school are very big fans of using the money supply to explain inflation. The basic tenet of their argument would be that when there's more money swirling around in the economy, it tries to find a home. It finds that home in goods and services and chases prices upwards, and is one of the primary reasons for inflation. And if you look at what happened in the pandemic, when a huge amount of economic stimulus was injected into the economy, aka the money printers were whirring, or at least the digital money printers were whirring, what happened? Well, after that, we obviously had a significant bout of inflation. So you would see some of the merits in their viewpoint. Now, the money supply has been trending back downwards for about 13 months on the spin before the last couple of months. And that was really needed. And that, I think, is also, it's no accident that it's correlated with the decrease in inflation that the UK has seen. But we had a fairly significant uptick last month. I prefer to look at the M2 money supply. There are lots of different ways of measuring the money supply, at least 5. I prefer M2, and M2 was up about 0.75% on the month. Doesn't sound like a lot, but that is still billions of pounds. Consensus forecast would have been about 0.25%, but instead it went up 0.75%. I think this is all feeding into the narrative that I'm starting to build, that guess what? A lot of the inflation forecasters are still wrong, and them thinking that inflation is just going to tail off back to 2 and below, and I've even seen some consultancies forecasting it's going to go negative this year. I just can't see that being the case, I'm afraid. There's still a sting in the tail here. It's a slow and bumpy ride down to 2%. And I did cite the fact that even in the last decade, which wouldn't have been characterised as one with significant inflation, if you remember pre-pandemic, 2010 to 2019, average inflation rate in the UK, 2.7%. Who wins most from that inflation rate being out there? The government do, because they don't increase thresholds, and there's a big debate at the moment about mileage that HMRC allow people to claim. Still 45 pence a mile. Used to be pretty fair. Nowadays, barely pays for the insurance on some cars, I'd imagine. But of course, this is just the carbon monoxide, the unseen part of inflation, where the government just takes more and more and more money out of our pockets. And they have to try and keep up with an incredibly burgeoning health service that's spending more and more and more in real terms, apart from anything else, constantly expanding, not under control because no one can swallow the bitter political pill that would be needed to truly control what free healthcare at the point of consumption should look like in the UK. But I digress anyway. So we're going to be watching the money supply closely in following months, because if that's a trend back upwards, look out, because inflation won't be sticking around the sort of 3.5-4% mark. It'll be going back up again, particularly if we have another hot war. So then the nationwide house price index. So there was a nice increase, 0.7% month on month for January. So a good start to the year. It shows a minus 0.2 over the last 12 months. So much more positive than a lot of forecasters were predicting. The consensus was 0.1 for the month on month rise. So once again, the consensus was completely wrong, and it's more than 0.5% miss to the upside. Really shouldn't be that hard to predict. I'm not surprised at all, because anyone who's not an idiot could have said, well, hold on, rates have dropped significantly, especially in early Jan. That's bound to have shown that availability, that price of credit is bound to have had an impact in the market. And it has. And of course, there is an element of new year, new optimism. I'm certainly feeling that in some of the, not all of it, but some of the business community that I speak to, and also some of the consumers and the investors that I speak to on a day-to-day basis. So I still think we'll have a real terms house price fall this year, probably, or perhaps a break even now with where things are at. But that is really predicated back to my inflation point of view, that around 3.5 to 4% this year as an average is a pretty good guess. And of course, my conspiracy theory behind that the government are absolutely delighted about 3.5 to 4%, because it's a nice way to take extra money out of everyone's pockets. And everyone knows with tax revenue, in spite of all the people who go around saying we need to tax the rich, we need to tax the wealthy and all the rest of it, they do pay a lot more tax than everybody else. Percentage terms, they may well not pay more, but of course they can pay more advisors, which also adds to the GDP and keeps people employed. So we should remember that. But really, tax revenue comes from the middle classes and the working classes in significant volume. And that's the only place it can come from, unless you want significant cuts at the governmental level on what we consider to be basic public services that we're busy, usually in the UK, slagging off apart from anything else. And then the Bank of England meeting, as I say, the meat of this week's efforts. So the vote was to hold the rate 6-3 as publicised, but actually that was 6 to hold, 2 to raise it, and 1 to drop it. And the 2 that voted to raise it had voted to raise it. This was the 4th time in a row they voted to raise it. One that voted to raise it last time round, which was the middle of December's meeting, now voted to hold. And then one of the holders dropped down to cut. So the first vote to cut we've seen for over 12 months, seen as a pretty good sign, but I've maintained, and I still maintain throughout, you're not going to see a cut until you've seen that meeting where at least all 9 vote to hold, or now I think we know one is going to be voting to cut here on in, unless there's any material changes. And therefore you might see a vote that looks something like 7 or 8 say hold and 1 or 2 say cut, before we see a meeting where there actually is a cut. And I think this is a positive thing. I think the bank is showing its independence. I think the externals on the committee are much better, bigger and braver at voting than the internals that work for the Bank of England. And I'm very pleased the committee is comprised in the way it is, although I have a significant lack of faith in the governor. I'm afraid they need to keep interest rates high. They've got to try and keep this inflation under control. They have a job to do, and given that their collective salaries on the Monetary Policy Committee run into the millions of pounds, they haven't done a great job doing it over the last 18 months, let's face it. I did make the point, though, that I'm coming around to more and more, and this is a hindsight is 2020 point of view, and I was a huge fan of Mark Carney, and I still remain a huge fan, but no one is holding his feet to the fire, saying, why didn't Carney try and lead the charge to cut rates, to increase rates, back in 2014 or so, in a very gradual way, because we wouldn't be in the mess we were in, and we wouldn't have had all the quantitative easing that we had to use and all the rest of it if we just swallowed our pill. But we continue to do politics and also things that impact the economics that impacts politics in a kick the can down the road fashion. Nobody wants to swallow the difficult pills. And that's why things will continue to look hard and improve very, 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 very slowly, if at all, over the coming years, regardless of who's in charge of the government, I'm afraid to say. So hopefully there's a lot of information there, but it's a little bit of insight into why I look so closely at the Bank of England meetings to try and understand what's going to happen to the interest rate. The bonds and swaps had a very variable week where they actually dropped quite a lot, even after the news that rates were being held and weren't going to be cut at any time in the near future. But that came right back on Friday, even as we looked at a hot war situation potentially emerging in the Middle East.